My name's Prentice Gary. I'm managing partner at Carlton Residential Properties. Carlton was founded in 1991 amid the real Texas recession. Carlton started operations as an affordable housing builder-developer using tax credit subsidies way back when Edwina Carrington was ED at TDHCA. We've continued to be a affordable housing developer, but also today do market rate housing, general contracting, and asset management. We've been operational in the Austin market about 10 years. Carlton Construction was privileged to be the general contractor for the Diana McIver's recently completed signature mixed income project, Aldrich 51, here in Austin over at Mueller. And today, Carlton is performing in partnership with HACA and Mike Gerber for the redevelopment of the historic Chalmers public housing properties just east of Highway 35 on 2nd Street. And just as a sidebar, first-class location, Class A product, all the amenities of a market rate development, and it's going to be a fabulous project. The key thing here is anybody that lived at Chalmers prior to this redevelopment will have first choice of returning and living at the new development, which I think is just great. I was asked why Carlton chose to be a sponsor for today's summit. Well, we've been involved in and had a commitment to preserving and production of affordable housing for over 25 years, and we've witnessed the widening of the affordability gap in the Texas market. The city of Austin has experienced national attention for its exceptional growth and quality of life for its residents. If that positive distinction is to continue, workers and employees at all levels will need the stability of having a decent and affordable place to live where they work throughout the city. The availability of affordable housing is simply good business in all respects and supports dynamic economic growth. Ultimately, affordability translates to subsidy, dollars and cents. Without the research, education, policy focus, and advocacy provided by organizations like Housing Works, the issue of affordable housing would not be as prominent in front of the stakeholders and policymakers. Fewer subsidy dollars would be available, and likewise, fewer affordable housing units would exist. Okay, the subject for the general session this morning will be reviving the middle class, building wealth initiatives in our communities. A little background. In 2015, the Pew Research Center reported that the American middle class no longer made up a majority of the nation's population. In addition to income inequality, other forces have exacerbated the trend, including systemic patterns of intergenerational wealth transfer, the foreclosure crisis, and the uneven recovery from the Great Recession. This panel will address the policies that have created or worsened these inequalities and the impact these trends have had on the nation as a whole. The panel will also focus on the tools that communities can use to build wealth and address income disparities, particularly for low-income residents and communities of color. The panel will be moderated by Michelle Dickerson. Michelle Dickerson is a nationally recognized scholar and a global media expert on consumer debt, housing affordability, and homeownership. Professor Dickerson joined the Texas Law School faculty in January 2006 and served as the Associate Dean of Academic Affairs from 2006 through 2011. She currently teaches remedies and federal civil procedure. Professor Dickerson is an elected member of the American Law Institute. She's the author of Homeownership and America's Financial Underclass, Flawed Premises, Broken Promises, New Perceptions. Dickerson has participated in congressional briefings and has testified before a congressional subcommittee on housing unaffordability. Her current research focuses on income and wealth inequality, and she is currently writing a book on the neglected middle class. To lead us into the panel discussion, first, Emily Perlmeter will present her report on consumer credit trends in Texas. Emily is the Community Development Advisor at the Federal Reserve Bank, where she is responsible for overseeing surveys and quantitative research for the department. She provides analysis and research on issues relating to consumer finance, affordable housing, small business, and impact of public policies on low and moderate income communities. Emily?
Hey all, me again. So before we get started into our next panel, I wanted to talk a little bit and set the context. So this is going to serve two purposes. One, of course, set some context for our next panel, which is going to get into a lot more of the meat and substance of asset building and wealth accrual. But I also want to preview some work that will be forthcoming from the Dallas Fed Community Development Department that discusses consumer credit and debt trends across the state and in some major counties across Texas. So this data that I'm about to show you, it's just a subset. I'm going to talk specifically about Travis County, since that's where we are today, and Texas as a whole. It comes from a nationally representative 5% sample of Equifax. So Equifax being one of the 3 major credit bureaus. So we took a look at the 4 major types of loans. So those are mortgages, credit cards, auto debt, and student debt. Those are representing over 90% of an individual, on average, their credit portfolio. Very important disclaimer, nothing I'm about to say, good or bad, is representative of the Federal Reserve System. These are my opinions, mine alone. So let's talk a little bit about how important accessing credit is in our society. So think to yourself right now about what you have been able to do because you have access to credit and debt. Buy a home, rent a home in most cases, go on vacation, go to school, pay for your kids to go to school, buy home furnishings, almost everything. So if you don't have a credit profile, think about how outside of the mainstream economy you would have to be. So being able to measure what % of our communities can be an indication of how inclusive our economy is. So nationally, about 90% of adults 18 and over have a credit score and a credit portfolio in Equifax. In Texas, that's lower, that's 86.5%. So that's nearly 14% of adults in Texas who are not included in the credit economy. So we could maybe think of this as Texas being a less inclusive economy than nationally. Actually, Travis County specifically performs even worse. About 18% of adults in Travis County don't have a credit profile. So if 86.5% of Texans have a credit portfolio, who's carrying active balances? So clearly, this is probably not a surprise, the majority have an active balance on their credit card. 38% have auto loans, just under a quarter have a mortgage, and 17% have student debt. Okay, so we also want to take a look at the median amount carried for each of these loans and how they've changed in the past 12 years. So here's a table with all the dollars adjusted for inflation, so you know that you're looking at apples to apples. These are all in 2018 adjusted dollars. So you can see that the median auto debt has basically remained the same, even a little bit down. And credit card balances actually decreased quite a bit. There actually is a policy implication around some of that. There's a legislation called the Card Act that was passed that I think was responsible for a good portion of that. Mortgages, of course, have the highest dollar amount, and you can see that they've now surpassed their pre-recession height as far as median balances. And interestingly, interestingly, median student debt has actually skyrocketed in those past 12 years, and it's 43% adjusting for inflation. So that's the median student loan debt. The average is actually a lot higher. It's about $30,000, and this is in the state. We want to take a look at credit scores using Equifax's risk score measure, which is the same thing as a credit score. So they're calculated based on a few factors, and that's the number of loans a borrower has and if they're being repaid on time. So Equifax calculates credit scores in an attempt to predict the risk that a certain borrower is going to be seriously delinquent, which is at least 90 days behind payment. So the lower the credit score, the more risky that borrower is presumed to be. Looking across Texas, we actually do find that the majority of Texans have prime credit, scores that we call 680 and above. You can see, of course, they're very unlikely to be seriously delinquent, 0.06%. But there's another significant chunk of our state population that has what's referred to as either subprime or deep subprime credit, which is more than a quarter of our population. And those seriously delinquent rates on average are about 9.5% for those with subprime, and for those with deep subprime, it's almost 30%. So now, that's Texas, let's look at Travis County. So I would note a couple things. First, there's a higher proportion of borrowers in Travis County who actually have prime credit. So only 18% of Travis County residents have subprime credit. However, what's interesting is that they seem to be struggling at a much greater rate to make on-time payments. So their average rate of serious delinquencies is about 12% for subprime and approaching 35% for deep subprime. We know that credit scores can obviously impact the size of the loan. So lenders often want to restrict access to credit for subprime and deep subprime borrowers. We can see this most obviously in mortgages. So even though these borrowers make up 18% of the overall Travis County population, their share of mortgage debt is less than 2%. This table likely would have looked a lot different pre-Great Recession, but of course lending standards have tightened. You might notice something else here though, and the numbers that I've highlighted in red, these are the only instances in which the portion of debt carried by the subprime and deep subprime borrower is disproportionately higher. So for instance, 31% of the student loan volume in Travis County is carried by 18% of borrowers, those with subprime credit. And auto loans actually do have a little bit of a higher share as well. So this could suggest that credit is less restricted for these types of loans. Student loans, as you may know, are quite a bit different though than other types of loans just because the federal government originates these loans. They guarantee debt for all students regardless of credit history or parental credit history. And Congress sets interest rates and borrowing limits, and students from all credit backgrounds are offered the same price of debt. All right, next, we're going to take a look at the geographic dispersion of credit scores across Travis County because there's a distinct pattern. So on the left, we've got our credit score map. And you see the I-35 and MOPAC to orient yourself for those who know Travis County and the city of Austin. The purple regions that you see are the very high credit score regions, and this is by zip. And so the orange, of course, represent the lower. So we can clearly see that eastern-western divide for those who know Austin. So to the right is our income map, which really shows very similar patterns as our credit score map. So income is not a factor in calculating an individual's credit score, but we know that these things can be interrelated since if you have more money to pay back your loans, right? But I think these maps can illustrate something a little bit deeper as well. They can give a sense of the income segregation in our city and the credit score segregation in our city. We can also think about the historical context, how this city was zoned for those who know a little bit about Austin's history, and how limited access to credit and wealth building for certain neighborhoods and particular communities can have intergenerational impacts, which I think is something that I'll leave for our next panel to delve into. Lastly, I'm just going to show you that it's not just the volume of loans, but the trend of delinquencies from 2003 onward. So we can see serious delinquencies increase during and after the Great Recession. We already know this. But something important to note is how much student loan delinquencies have increased since the very beginning of this chart, 2003. They're around 11% and much, much higher for those with subprime or deep subprime credit. We're starting to see some upticks in auto debt as well for Travis County. But the student debt piece is such an important one because it's so complex. So student loans are incredibly hard to discharge. You can't discharge them the way that you can with car repossession, foreclosure. So if you're saddled with that debt, you're saddled with it for a long time. But we also want, I think in this country, we have a feeling collectively that higher education is something that all of us, regardless of our background, should be able to access. So it's not about purely panicking that these serious delinquency rates are rising. It's about being thoughtful and balanced about how to empower consumers to understand the loans they are taking out and to make sure there is equal access for higher education for everyone.